Hey guys, it's Adam Heavener up here, CEO at Modern Mortgage, and I'm following up with you for a special version of our Weekend Weapons series. And you guys know we're always sending you out information and update of interest rates, all that kind of stuff as you head into the weekend. But obviously, with all that's going on with the coronavirus, I wanted to make a special video for you guys to explain a couple of key concepts that you're going to need as you start talking to buyers and just members of your database through this weekend. A couple of things I want to communicate. Number one, we're going to talk about the interest rates and what's going on with the dislocation. Why are we seeing T-bills drop? Why are we seeing bond yields go down, but interest rates are up from where they were last week? Why is that going on? That's something your buyers want to know. And then secondly, should I still be buying a house? This is what people are scared of. Our investor clients are asking that question. Our buyers are asking that question. So I'm going to answer both of them for you. And I'm doing that in a way that I hope to equip you so that you're going to be ready to really care for people at this time. Now listen, here's the first thing you got to know, guys. This is a big deal. This is not overblown fear. This is not an overreaction. If anything, what we've seen so far, as of today, is an underreaction. And you're going to continue to see the stock market have trouble. Despite its returns today, you're going to see those returns melt and go back the other way pretty quickly. Now look, when that happens, people get scared of risky assets. They leave those risky assets behind and they go buy safer assets. And the kind of assets that they tend to purchase are bond-related assets. So T-bill is the most famous. You keep hearing that. That means Treasury bill. That means you're buying from the government the right to be repaid later. You're kind of lending the government money. There's other ways you can lend people money. You can buy a mortgage-backed security, and that's what sets interest rates for the mortgage market. You can buy junk bonds, municipal bonds. That's a debt for a town or a city. A junk bond is for a company. And all of these things are ways for you to own a loan and the right to be repaid some portion of a loan. That's what a bond is. Well, when people get scared of the stock market, they buy those bonds. And when lots and lots of volume is coming into the bond market, the interest rate can go way down. And that's what's been happening. That's why you see the T-bill trading at such historic lows right now. So you ask, well, if the T-bill's low, if all this money's coming into bonds, why aren't we seeing a big decrease in interest rates? Why did rates go up from last week? Well, there's two ideas I want to introduce you to, and they both start with the letter V. So you ready for my two V's? The first one is volume. When interest rates dropped 2 weeks ago substantially, that created a huge amount of volume, and all of that volume is already in the secondary market, working its way through mortgage banks like mine and others. That's a big deal. All that volume just takes a minute. It's kind of like a snake eating an elephant, and you just got to wait for the digestion to occur. Now, because of that volume, banks don't really feel like they've got to take on more risk, so they don't want to pick wrong in the secondary markets. So because of all of the volatility, that's the second V I'm going to give you, because of all that volatility, the banks are just hedging above that, and they are not taking advantage of the lower rates. They're slowing it down in order to staunch both volume and protect themselves from volatility. Now, because of those two things, you're seeing mortgage rates are much higher than they should be. They're as high as they were last spring. Now, given that, here's what we recommend. I think you still need to be moving forward with your purchases. You still need to be moving forward with your refinances. But what you're doing is you're talking to bankers like us. You're getting on the list and you're saying, hey, as soon as the door opens, let me know and let me lock it in. Now, that's important for you to do. You've got to get locked in. You can't spend 3 days thinking about it. You've got to think about it now, because when that door opens, you can get out, but that door can very quickly close again. And we've got lots of clients saying, oh, we wish we would have taken your advice last week to lock. We wanted to think about it, and now it's too late. That's okay. Don't worry. It's going to come back. Okay? That's how we're thinking right now about how interest rates are working. Now, let me talk a little bit about that other big question, which is, with all that's going on, should we continue moving forward with our purchase? Maybe I'm an investor. Maybe I'm just a first-time buyer. Maybe I'm somewhere in between, buying that third home, and we love the home, but we're afraid to move forward. Is it going to be worth less later? Are things changing? Well, here's what you need to know. The market is fundamentally changing. It is becoming a different kind of market. It's moving from a deflationary environment to an inflationary environment. And here's the good news. Inflationary environments are very, very good for paying back loans. So if you're buying real estate with a loan, that loan is going to get easier for you to repay over the coming years. So you want to lock in a very low interest rate. So now is the best time to buy. I know we often say that, and it has to do with the economic environments we've had. So as things change, purchasing a home in this inflationary environment is going to be good for you. So what changes? How should we be thinking now? Here's how you got to think. Here's how you're going to advise your clients. And if clients are watching this, here's what you need to know. It is more important than ever that you protect your reserves. So if you were putting down 20% and that was the last penny you had, put down 15%. Keep the other 5% in your pocket for a rainy day, because it's raining, okay? If you're doing a refinance, instead of trying to get the very lowest payment you can possibly get, go a little bit higher on the interest rate. Take another quarter. It'll change your payment by about $40, and take some cash out of your property. Taking cash out, again, you put that in the pocket, and what it does is actually make your home much easier for you to pay back. So as we're counseling buyers, as we're counseling consumers of mortgages and ultimately buyers of real estate, we want to encourage you. If the bottom falls out of the market, you want to own real estate. Real estate does fantastic in situations like this. So buy real estate. That will protect your funds. A. B. If you're going to buy real estate, you must buy with reserves. Make sure you're protected. You've got a little extra cushion than you normally do, and that'll empower you to hold the property over the long term. And that's the key. When you own real estate for a long time, you win. So I hope this weekend weapons session helps you. This is our special coronavirus update, and we're going to be coming to you with more and more information all the time. So if you've got questions for us, want to know more, need resources on how to talk to people, or have questions about how the market's working, we're working overtime to make sure we're supporting our agent partner population. We love you guys. We're here for you. And if there's anything at all you need, you know how to get us. Thanks again, guys. Adam Hebener up here, CEO at Modern Mortgage, and looking forward to taking care of you soon. Bye-bye.